Welcome to TheoTrade. This is Don Kaufman. It's February 7th, 2025. There's just about 50 minutes to go to the cash close here on this Friday afternoon. The S&Ps, they're getting rocked right now to the tune of about 1%. I mean, how do you describe yet another week like we just went through? Well, I'll tell you what, this TheoTrade weekend update is entitled How to Ride the Great Risk Roller Coaster. It's kind of like the Great Space Coaster, except with the marketplace. So I am going to talk a bit about how to strategize around this. And I got to tell you right now, I like it. Like this two-sided trade, this is what does it for me. We're range bound. It's wild. It's two-sided trade. You just have to kind of get what we're going to talk about right now is some orientation to where you are at any given point in time. Allow me to explain. Let's dig into it. Look, a lot of what I'm going to talk about on the weekend update here, really forward looking. Like, sure, we're going to talk about different levels, kind of some of the action that we've seen this week, but really forward looking, especially when you start talking about NASDAQ, which it's getting rocked right now. We're at actual lows. S&Ps are off 60 points, and you're like, where is this coming from? It's coming from wild uncertainty right now. All right, let's start. So the first thing I want to bring up is the SPX. And you guys, you'll always hear me call this, it's the mother of all products. So once again, and I say once again because this is 2 consecutive weeks now, we started off with, well, a wild start to the week. What I often term, it's Mr. Toad's Wild Ride. So 2 weeks ago, we started off the week with huge sell-side activity. It was the deep seek debacle. That's what I'm calling it now, the deep seek debacle. And then the marketplace, of course, rebounded, sold off precipitously on Friday, right? That's 2 weeks ago. This week, we started off with, I call it the tariff debacle. The marketplace saw the lower edge of the expected move. And when we opened on the lower edge of the expected move, which is $104, we rebounded, literally on Monday, Tuesday, Wednesday, Thursday, and here we are in this Friday, some sell-side activity. I got to tell you, though, the sell-side activity right now, this marketplace, like I get it, it's only down 60 handles, but it feels really, really heavy. And by that, I mean, like it feels like there's some fairly hideous and precipitous sell-side activity. It's kind of bleeding through. I mean, look, so it's a wild week again. You almost have to, you're going into like Super Bowl weekend here. You're like, oh, what's coming next week? Let's assume that you want to assume that there's not going to be anything major over the weekend, but this is the Trump administration. And all of that is thrown out the window. In fact, we're going to discuss that here momentarily. If you're throwing your hands up in the air as a trader, you're like, this Trump administration, they're killing me, And no, they're not. You just got to learn how to actually, navigate in and around some of the chaos, because chaos is a very, very good thing. That's why I'm calling it, it's the great risk roller coaster. All right. The first thing we're going to start with is just that. So yeah, there's some sell-side activity right now, yada, 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 move forward. The tweets, okay? So the tweets and really news that's breaking out of the current administration, kind of wreaking havoc in the marketplace. We saw it again today. So some precipitous drop in this morning. There's been a number of precipitous drops this morning, largely based on information, of course, coming out regarding tariffs and retaliatory tariffs, yada, yada, yada. Okay, tariffs everybody expects. It's some other exogenous event, though, that's really going to rock this marketplace, no question about it. And by definition, some exogenous event, you don't know what it's going to be. There's going to be a catalyst. It's going to get thrown at this marketplace. Things are going to get crazy, okay? And we keep seeing this again and again and again. These tweets are really rocking volatility, which is an interesting kind of concept, because one of the trades that I'm doing right now is I got long volatility, but I didn't actually use a spread. I just went out like 67 days and actually bought an in the money call. It's actually one of the level 1 trades that I shot out this week, and I like it. The more and more I look at it, the more and more I like it, because what's going to go on forget about the next, couple of days, the next couple of weeks, the next couple of months. What is going on is the administration, because of the hideous amount of uncertainty, okay, it's likely to keep a floor under volatility. What I mean by that is it's exactly what it sounds like. So let's assume that that floor might be somewhere around the 15 level in VIX. So every time we come down to 15, I bought it the other day, and here we are. We're bouncing back in terms of volatility. So I think that's going to be a trade that we're going to continue to look for, So I think there's actually some great trades in the VIX, some sell side activity. It's going to bounce. Let's get crazy. A little bit more sell side activity. I'm going to catch both the bullish and bearish trades inside of VIX. You just got to be mindful. Like VIX options, they're just not based on what you think they're based on. And that's something that, we'll describe, of course, in TheoTrade throughout the course of the week. So tune into the chat room so I can kind of fill you in. You're not basing your trade in VIX on 1650. You're basing your trade on the on forward VIX, which is these volatility futures. So I'm 67 days out. If you take a look at the volatility futures, open them up, okay? The volatility I'm trading is based on the April vol, which is 1828. So when I say that I purchased a 15 call, that thing is in the money, okay, considerably. It's not in the money to the tune of, it's 1650. Product I'm trading is like 1850. So this is fairly deep in the money, which is like I'm basically long vol right now, just long vol, waiting for vol to expand out. So, again, wild week to start with. Things kind of, cooled off in terms of volatility, just enough to actually provide, well, good opportunity in volatility. So those tweets are going to keep a floor under volatility. Now, something that I mentioned, of course, in the Wednesday night update, I mentioned it last weekend. I'm going to mention it again because there's a range right now that defines us all. The best way to do it is the 180-day 4-hour chart. I zoom into it. When I say the range that defines us all, and I keep just hammering this. In fact, let me just close up this left side bar because I want to give you full screen. Let me give you the full Monty over here. Okay, the full Monty is the range. Okay, is roughly, and again, I want to detail it. Like I told you guys, I would detail it here on the weekend update. Now I'm going to detail it. The actual numbers in here are roughly 59.11 to roughly 61.11. So this 200-point range. And one of the things that I was talking about considerably on the Wednesday night video is just because we're at the upper edge of the range, it gets interesting at that point, but it doesn't mean squat. Okay, it wouldn't mean squat if we're sitting at the lower edge of the range. The bottom line is there's been an absolutely catastrophic amount, of option activity in a 200-point range. And the more activity, in this tight of a range, it's a snowball at this point. So we have this just massive risk. And when we start to crack the range, boom, we're going to explode higher or explode lower. And again, as I reiterate from my Wednesday night video, it didn't matter whether we're at the upper edge of the range or the lower edge of the range. It's only going to matter when we actually break, that range. And it's going to get crazy. There's just no question about it. And you'll know when we break the range because the marketplace is going to see high degrees of correlation. And here's something interesting, though, today. The correlation today in the S&P 100 is really freaking high compared to what it was. This could be a little bit of a warning shot across the bow. I know we only have 40 minutes left at the close, but could we get all kinds of crazy and start seeing real sell side activity? The answer is yes. But I don't think we're breaking through 5,900 by today's close. I mean, you're 145 points away from that. That's just not going to happen. But again, the correlation is coming closer and closer. And what I mean by the correlation is, look, if there's 90 products trading to the downside, that's full-blown correlation. Right now you're at 80. So you're 10 stocks, some sell-side activity away from greatness here. Be mindful of it because that correlation is if you will, it's going to be the snapping point in the range that we're in. So I want to reiterate one more really important aspect about the range, and that's stop trying to handicap what you think is going to end the range. Okay, meaning stop trying to sit here and prognosticate, oh, this is what's going to cause us to go to the upside. It doesn't matter. It doesn't matter. Who cares? Okay, you got this range. And the other thing is don't try to handicap whether we're going to the upside or the downside, because the truth is nobody has any idea. I mean, I talk to trading firms every single day. Everybody's like, oh, we break this range, it's going to be wild, because we all see the same thing. We see there's critical amounts of risk that have accumulated in here. We are in the red in terms of risk right now because when you trade in the same channel for such a long period of time, the risk does nothing but just it keeps adding up and adding up and adding up, and that's where we're at right now, right? All right, so the ES range that defines the markets. Now, when I start talking about the great risk roller coaster, what I'm really referencing in this front, go back to the range for a second. This is it. It's a great risk coaster. you can't make that crap up. It's a great risk coaster. It's just again, it's manic out there, but it's manic inside of a 200-point range, which ironically makes it that much more manic. It's like you're stuck in a padded room and you're just bouncing off the walls. Literally, you're 200 points higher, 200 points lower. You are in a schizophrenic marketplace right now. That's why, again, I call it the great risk roller coaster. Now, there's another side to this, and that is when we're pinging back and forth like this, I have tendency not to pay so much attention to individual stocks. We're going to talk about individual stocks momentarily. There's not a huge amount that is like catching my attention. I'm like looking at oil. Okay, there's some sell side activity in there, yada, yada, yada. Looked a little bit at the dollar. Okay, the dollar is kind of flattened out. There's some volatility in there. I looked at gold and thought, holy crap. I've been looking at this every single day, just like all traders are. And I just keep questioning, and I can't help, and I have to bring this up in the weekend update is, what in the hell does gold see right now? And everybody should question that. Well, it sees inflation, but it just, that doesn't work for me. When I say it doesn't work for me, does gold really see inflation? Because the interest rates are, the interest rates have actually gone back down a little bit, right? So I'm not sure inflation is it. The dollar hasn't really, had much action that it's going to move gold. This really bothers me at this point. So it could just be a trade. All of a sudden, everybody's like, let's momentum, gold to the moon. But it's just too big. And I'm bothered by it because I cannot help but believe there is some type of risk aversion that is going on in here. I mean, look, we've all seen gold rip higher. Okay, but this is something completely different from the beginning of the year. Okay, to right now, this is wild. I mean, sometimes GC doesn't do it. I like to look at GLD once in a while. It's a little bit of a cleaner chart, right? Again, we've all seen dramatic moves in gold, but this is about as close to what we term parabolic, ever increasing, slope to the upside. This is parabolic move inside of gold. If you're not disturbed by it, you're not paying attention. Okay, and maybe I take a position in here that's, looking for a little bit of retracement lower, because taking a look at this again, this is a big breach to the upside of expected move, hits the upper edge of the expected move, outside the expected move. I mean, that's 3 consecutive weeks. Maybe it needs a little bit of a pullback, but another portion of me says gold knows something that we don't. Okay, and that's the way that I'm actually positioning it here on this weekend update is in the great risk roller coaster. Gold seems to know something that none of us do right now. There's got to be a clear and decisive reason of other than just momentum traders hopping in here. Okay. And of course, I'm going to get 50 emails now. They're like, this is the reason. Okay. I don't really care what you think it is. Okay. I'm telling you what I think it is. And that is simply, there's some risk aversion going on. People are actually, using gold as in the end, you'll have gold kind of thing. This is, it's not a good sign though. I don't think for the equity markets. I don't think it's a good sign for the equity markets. I think we're actually seeing some flows from stuff like Microsoft. Okay, hitting lows. So let's start to bring up a couple of the individual stocks. I think there's flow capital from major market cap, okay, into places like gold. Right now, there's so much money out there still, and it's seeking returns. And unfortunately, that money is just being they're throwing caution to the wind in a lot of circumstances. Anyway, let's come to some of the big boy market caps, Microsoft, Apple, Google, Tesla, Nvidia. Why did I bring those products up? Well, first I wanted to start with Microsoft. Okay, let's actually open up just a 3-year, just get a quick feel. Okay, Microsoft right now is coming into what I view as a very, very critical level. Okay, you can call this 410 level. That's pretty critical. Yada yada yada. Okay, yada yada. Right over the best part, but this looks fairly critical. Okay, to me, breaking through 400 might be pretty devastating at this point. There just doesn't seem to be a lot below that. So Microsoft is right there, really geared for a breakdown. It just is, right? So that's going to be worth watching this next week. It's through its earnings, so there's no discussion there. Let's talk about Apple. Apple, the 220 level, unequivocally, okay, means something. It's right there, okay? Well, let's talk a little bit about Google. Google, off its earnings, already broke through a fairly critical level of 190. It's hanging on like grim death until today. It got pummeled again. Okay, so Google, it's down. It's definitely not out. I mean, look, you're like 3 days removed from its all-time high, but it's going to be worth noting. Okay, moving on over here, Tesla, nobody's loving that lately. Okay, it's off the 488 all the way to 366. It's down over $100. So there's some sell side activity. I don't have any great levels inside of here other than maybe 350 where it catches some support in there, right? Then obviously NVIDIA. And NVIDIA is once again, it's down. It's definitely not out. It's flirting with the 130 level. Okay, but the point that I'm trying to make over here is you have 5, okay, of the biggest market caps out there that are not in great positions. They're just not great. And yet we're still talking about a marketplace that's very close to like the all-time high. And you're like, I know, it just doesn't jive, right? Because we're getting these ridiculous capital rotations. People are like, let's buy financials. Yeah, JP Morgan's going to save us all, right? I've said this before, but like, if Jamie Dimon's in a lifeboat, I'd rather risk the open seas. So the fact of the matter is, the JP Morgans of the world over there, this is what's like saving the market right now. It's like a breakaway to the upside. Everybody's kind of missing that too. The rotations into like financials are freaking ridiculous. And I said last week, I'm going to say it again. I'm still short in the financials. I said it last weekend, and I'm saying it again. Yes, I am short. I'm short in JP Morgan. Okay, am I getting beaten up this week? Hell yeah, but it's where I want to be because this marketplace continues to come down. Okay, you pretty much already have beaten up a lot of the tech stocks. You really got to beat up financials. Okay, so keep it in mind that you have 5 major products to the downside. And then when I say that, earlier I was talking about, money managers just throwing caution to the wind. This is throwing caution to the wind. I think this is the 15th or 16th up day in Meta, consecutive up day in Meta. Meta looks like it's going to finish positive today, still holding the marketplace holding to the upside, but it's just wild out there. Okay, there's not a lot of other pockets of real strength in here. I mean, yeah, we can mention like Amazon. Amazon broke a little bit. Okay, and Amazon did not have a great earnings outlook, so this might see some more sell side activity. But here's the bottom line. Okay, outside of Meta, big tech right now looks like it's in trouble. Just looks like it's in trouble. And we're not seeing it, though, in the broader marketplace because it's being covered up very nicely, okay, by huge inflows to places like the financials. All right, onward and upward. How, okay, do we ride the great risk roller coaster? So with the S&Ps just ebbing and flowing back and forth, like this chopped up volatility, let me give you a great idea, like in-out spreads. I did one today in the XLU. Okay, and I did an in-out spread in the XLU, which is, and by the way, I'm going to be very, very clear. I did a bearish trade today in XLU. Okay, and some people, oh, what'd you do in there? Here, okay, you want to see it? Apparently, 2,500 other contracts traded in here as well. So I did this bearish spread, but it didn't have to be with it didn't even have to be bearish. I did the bearish spread because it actually costs less than the bullish spread. But the bottom line is when I looked at auto expected moves, okay. What do you have in here? It's just a chopped out mess. We hit the upper edge of the expected move, the lower edge of the expected move, the lower edge of the expected move, right to the upper edge. To the upper edge, the next week was the lower edge. It's an absolute, veritable cluster. Beep. I mean, it's a disaster out there. Gotta love it. Why? Because the in-out spread is going to be profitable just in the noise. It's going to be profitable in the noise. I don't really care whether it's bearish or not. It's kind of an unusual trade. I'm basically doing a trade, because we're going to chop around, and I'm all about it. All about it. The next trade, so in-out spreads are a great way to trade through this. If you're at the upper edge of this range, bear up. You're the lower edge of the range, bull. and it's fine. Eventually you're going to be wrong, but who cares? Like, how many times we've actually gone to the upper and lower edge of the range. Okay. Where are you right now? You're getting ground apart in the middle. Okay. This is where, like, ranges like this is where retail traders go to die. It's why I call it, some people call it a volatility box. I call it a volatility box, but I've also dubbed this the hurt locker because, again, retail trade, they really get ground up in this stuff. All right. I also, obviously, I talked about this already. I use the VIX. Okay. I just bought VIX and just got synthetically long VIX. I'm also still trading a lot of SPX butterflies. Now this week, I'm going to miss. I'm going to miss in the SPX butterfly. I did hit one butterfly though this week, big, really big. I hit one in Lilly. So in Eli Lilly, I closed out of that thing for over $2.30 today. I think I paid 47 cents. Closed out of Eli Lilly though. You know what? I got to look at it. I traded a lot this week. I traded a lot. I hit one butterfly pretty good this week. Here it is, 47 cents into a 230 credit. So from a percentage point of view, winner, chicken dinner. Week in and week out, I keep showing you these butterflies, especially around earnings announcements. They have been real and they have been spectacular. All right. So with that, you got in-outs, okay? You got a trade in VIX. You got some butterflies. Don't get cute. Just don't get cute. Don't get ground up in this, okay? Sit back, position yourself effectively, position yourself at defined risk. You're going to be just fine. Last but definitely not least, we go to the SPX. Again, the mother of all products. What do we have in the SPX? So this past week, okay, the week we're coming out of right now, we had roughly $104 expected move. Actual move, massively unchanged. I mean, look, we hit the lower edge of the expected move, rallied back, and looks like we're going to end the week for the most part unchanged. I say unchanged. We started the week at 60.40. We're trading right now at 60.27. Come on, that's unchanged, right? So we're pretty much right in the same place we were, at the beginning of the week. But what are we looking at next week? So next week, what happens next week? Well, first of all, we do have CPI. That could get interesting. Okay. You got a couple of Fed speaks. Fed speak Monday. By the way, Monday, the markets are open. Everybody always asks me about that. Yes, the market is open. Why would it be closed? It's just the day after Super Bowl. I know everybody's recovering, but recovering from Philadelphia win. Oh boy, I'm starting something now. Anyway, we'll have CPI like coming into Wednesday, some more data coming out throughout the remainder of the week. Okay, but the bottom line is, it doesn't matter. Okay, what you think of data coming out. All that really matters is what's the expected move. And next week is actually really similar to the risk of this week. It's about $100 expected move. So this week, again, that we're coming out of, it's about $104. Next week is right around $100 expected move. So once again, the only thing I can tell you right now, put on your big boy pants. We're going to stir up some risk again next week. And as I said, I like it. I like this two-sided trade. This is what we're about. This works for me. It's not a one-way ticket anymore to the upside. What we're getting right now, okay, churns people apart. Me, I'm all about the volatility. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.